Hello class, this is Brian from financialtrainingschool.com and welcome to BO109 Engulfing Candles. So this is going to be the third type of candlestick now. We've covered dojis and pin bars before. So this is what they look like. You can basically, the whole point of engulfing candles is you're supposed to spot the current close compared to the previous open. So you have two types, bullish and bearish. Depending on where they occur, bullish is usually found at the bottom, indicating a reversal up, and bearish is found at the top, indicating a reversal down. So bullish, you can see the current close is higher than the previous open, and this indicates it's going up because this one engulfs the previous one. E.g., this candle is bigger than the previous one. Basically, that's what engulfing is, right? The bigger one eats the smaller one. Then for bearish, you see the current close is lower than the previous open. And it doesn't matter. See, here I have a small one and a big one. This one, they're both relatively big, but this one still is bigger than the previous one, so that's all you care about. And basically, that's when you know that it's an engulfing. The next one is bigger than the previous one, then you compare the closes and the opens, and then you can see if it's an engulfing candle or not, and then you trade accordingly. And take note, where the current candle opens, it doesn't matter. See how this one, the open of this candle is actually above the close of the previous candle? That doesn't matter. If this open was down here, and it was below the close of the other one, still doesn't matter. The only thing you're comparing is the current close to the previous open. That's it. That's the most important factor of these. So for scenarios, just like I mentioned previously, these are reversal patterns. So like dojis and pin bars, engulfing candles are found at the top and bottom of a trend, and this usually signals a direction change. However, instead of floating, if you think back to dojis and pin bars, you usually have the previous trend, it's a green candle up to the top, then you either have a doji or a pin bar followed by a red bar and it goes down. So that's floating. But these engulfing candles are usually found in pairs. So you see the uptrend, it goes up green, and then the next one will be red, and then that's the engulfing candle, and then the pattern just goes through. So it's found in pairs, it's not floating. So you always spot them in pairs. And the reason why it's called engulfing candles is because they show a sudden increase in momentum. This burst in momentum originates from the fact that these engulfing candles are usually found in overbought and oversold price levels, thus the reversals that follow. Secondly, you can also think of this as an extreme short-term price action move, whereby the current candle manages to break past the open of the previous candle. So even if price is going in one direction, the increase in momentum changes direction. Okay, so you can imagine if you're in a car and you're driving around, and there's a car that comes out of nowhere. This forces you to make a sharp turn to avoid them. So that's exactly what happens when you have these engulfing candles. Price is going in one direction, but then suddenly some momentum changes, and boom, it just shoots past the open of the previous candle, and it closes up there or down there, and the engulfing candle causes a change in direction. And just a note for the chart examples, just like BO107 and 108 for dojis and pin bars, the charts will have the newbie strategy on it. So that's all the exponential moving averages and simple moving averages. You can refer to BO105 for these. In addition to show the overbought / oversold nature of prices, I will be using a few examples that have momentum, stochastics, and MACD. Currently, at the time of making this lesson, I don't have a revamped video of the old lesson yet. So to watch the video, just watch episode 9 of my old How I Trade Buying Options series. Just search MSM strategy on my channel and you'll find the video. Or you can just search on YouTube, episode 9 MSM strategy, and you should find it. So let's get started with the chart examples. I have a total of 5 or 6 chart examples, and it's currently the 4-minute mark. So I think this lesson should last another 5 to 10 minutes or so, depending on how long we go. And we're going to start with this example. On all of the charts, I already drew the arrows pointing to the engulfing candle, so it's easy to spot. So that's where it is. And most of the charts, I think all of them actually, are on 5-minute charts. So you can just assume that they're all 5-minute charts, because that is what I use. So I'll just zoom into that. So you can see here, this is a green candle. This is the engulfing candle. The close of this candle engulfed the previous open. The wicks don't matter. I forgot to mention that in the actual slides, but the wicks don't matter. You only compare the bodies of the candle. So this body is bigger than this body, and then basically from telling the bodies are different or bigger, you can tell where the engulfings happen. This one is closing above the open of the previous one. And for the first 2 or 3 examples, I think, the engulfings immediately reverse. So if you enter on the next bar, for the next 15 or 30-minute expiry, you'll be fine. But for I think the third or fourth example, I have them showing pullbacks, and those ones you want to enter for longer expiry so that the price will actually close above or below the current bar. So you can see this one, it goes up. So if you entered at the open of the next one right away, and this is the 15-minute mark, so you would enter for either the 30-minute mark, 45-minute mark, or any of the hour, and you'd be fine. So that's the first candle. So this is fairly simple, unlike dojis and pin bars, which I mentioned are floating. So let me see if I can find one. See here, doji is, this isn't really at the top of a trend. It's not like a perfect example, but I think you get the point. The doji is floating by itself there. You have the green previous and the red afterwards, and the doji is floating there. Whereas here, the engulfing happens in a pair. So you're not looking for single candles, you're looking for a pair of candles where one of them is bigger than the other one, and this is usually found at the bottom or top of a trend. And that's it. There's also another one right here. I didn't include it because this is kind of hard, because this is still in the trend line and the upward channel. It's kind of hard to spot. It's not as clear as this one. This one's immediate, because this one, it starts getting choppy later on, so it's not a clear reversal, but it does indicate the top is near, so you can use that in that sense. So when you see these, just start being careful and start to realize that maybe soon in the immediate future it'll start to reverse, and it does reverse shortly, but it doesn't. It starts getting choppy later on, so that's not a good example. This one is a good example right here. Next up, we have this one, also another clear example. It does go up, it doesn't get choppy like the other one, but this one, it does pull back later on. So this is where I mentioned you should trade for longer expiries. So if possible, you should trade for the next 30 minutes or the next hour, because these are more long-term reversals compared to dojis and pin bars. Dojis and pin bars are more immediate because it shows that it opened and then the price pushed down to the open price or the close price or whatever, and such that you get the form of a doji and pin bar that shows immediate momentum. This one shows overwhelming momentum afterwards, whereas that one is in the current candle, this one's afterwards. So it's kind of different dynamics in terms of how the candles actually traded. So this one, if you entered on the next candle, so this is the engulfing candle, which engulfed this one. Clearly, this green candle is bigger than this small red candle. The next one, if you entered it on the black line right here, I have it over the candle by accident, but that's just the chart. If you bought it right there, the call, if you entered for the next 15 minutes, so you might have lost because this red actually closes near it, so that's not a good one. But if you trade for the next 30 minutes or something, it would have been a lot higher, so that somewhere here it would have expired. And also, this is the three indicators, the momentum, stochastic, and MACD. As you can see, MACD, so this is just a preview for the revamped video, or if you watched episode 9 of the MSM strategy of the old series, this is a cross in oversold areas. This stochastic crossed up at the bottom there, and this MACD crossed up at the bottom there, showing an indication of upward movement. Combined with the engulfing candles, you can just combine the two strategies. So this is a nice way to use this. So this is engulfing. Next, we have engulfing in the bottom and top of a overall bigger trend. But see here, they both also have the confirmation of MACD and stochastic. Momentum is ignored for the purposes of this lesson. If momentum doesn't matter in the sense of momentum of the candle, because you already see that inherent inside the engulfing candle. So for the first one, this engulfing candle right here, you can see if you dot all the way down, this stochastic crossed up and this MACD is about to cross up, so that's indication of reversal. So that's just confirmation for the fact that this green candle engulfs the previous red candle. You have a slight pullback, so if you want to wait, possibly you could get a pullback entry so that you enter there. This is kind of like a pin bar trade. A pin bar, you wait for the price to reverse up to like half of the body of the previous pin bar, and then you enter. So this is kind of like that. So you could use the pin bar strategies, the mindset inside an engulfing candle. So if you entered on the pullback, you would have been great. But if you entered on the open of the next candle, you still would be okay for the next 15 minutes. Next 15 minutes, it would have closed up. Next 30 minutes still would have closed up. Next hour still would have closed up. So depending on what time frames you're trading, they all would have closed up. Next up, you have this one, which is also engulfing. This red one engulfs the green one. And just like this one had a pullback here. So if you enter on the pullback, you would have been great. Otherwise, if you entered on the open of this one, you still would have been great for the next 15, 30, and maybe even 1 hour mark. So that's it. That's it for this example. And also this red one dotted down, this is where stochastic crossed down, and also where MACD is about to cross down soon. So that's just confirmation. Moving on to the next trade. This one, same thing. We have engulfing and then a pullback, and this is actually a really big pullback. It goes back all the way near the open of the engulfing candle. But here you can see, if you go down to the stochastic is about to cross, and MACD is not even close to crossing. So this is a bad example for oversold areas. But you can see from the engulfing candle, if you wait for the pullback, enter a pullback, and you'll win for the next 15 or 30 or even hour mark, depending on how long you're trading for. And then we have this chart, and I think this is the last MSM chart before the last example, which is another chart. The reason why I wanted to show this one is because you can see the choppy nature, how price goes up and down, up and down, up and down, whereas the other ones are just clear up, then down, and then changing direction there. See here, this one is choppy at the bottom, and it's choppy all over the place here. Because depending on what expiries you're trading, you have to be careful. Because, for example, here, this green candle engulfs this red candle, great. The next one, if you enter it on this bar right here, and you trade for 15 minutes, and this one pulls back, and it actually closes down, so that's choppy in nature. You might lose depending on how close your entry was between this red open and the green close of this bar. But if you trade for the next 30 minutes, then you'll be fine. Or the next hour, then you'll be fine. Because further down here, it closes up for sure. But close short term, it doesn't close right away. So that one, you need to enter for longer. But then for these ones, you need to enter closer. See how this one engulfs. It does pull back. But then if you trade, so if you enter on the open on this one, you enter for the next 15 minutes, you're good. But if you enter on the next 30 minutes, it's down here. So you lose because this is choppy nature. So you need to enter smart. So you need to show either short-term movement or immediate-term movement. Long-term, not a good sign unless you go for the next hour. So if you close for the next hour, maybe. So if you count 12 candles, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So the next hour you'd be okay, but the 30 minutes you wouldn't be okay, or even 45 minutes you wouldn't be okay. 15 minutes or 10 minutes expiries would be best for these choppy natures because it's just going up and down, up and down. And if you refer to price action, this is in the middle, so that's a bad entry altogether. That's why if you do wait for the pullback, that would be the best entry. Same thing goes up here. This is the engulfing. If you enter on the next candle, you would lose if you enter for the next 15 minutes. You would actually have to enter on the next 30 or 40 minutes. So these chart examples here are bad. So these are varying expiries, whereas for these clear examples, they go for the next, the next hour, the next 45 minutes, the next 30 minutes, the next 15 minutes, and that's all good. But here in the choppy areas, when it does get choppy, you need to realize that it is choppy, and then you need to accommodate the choppiness and trade either shorter or longer term expiries. Lastly, for the chart examples, we have this one, and this is just to show choppy nature again. You can see there is clearly this one goes down, and then it goes up, and it goes back down, and then it goes up. So here, this is at the bottom of the trend, and it does reverse. You trade for this red bar open, you trade for the next 15 minutes, you'll be fine. The next 30 minutes, you would not be fine. 40 minutes, you'll be done as well. And the next hour, for sure, you would have lost. So it depends. It's kind of tricky. So the first one is you trade short term. Like I said in the last chart example, it depends. It's choppy. Then the next one is you can trade longer terms. You can trade for the next 15 or even at the end of the hour. You can trade for that, and this would win. And depending on if you wait for a pullback, you enter right away, you still would win for the next 15 minutes. But then for the next 30 minutes, you might not, depending on how far away the expiry is. So that's it for chart examples. I'm done. I think I did a total of 6. As usual, my recommended brokers are 24 Option, Bank to Binary, and TradeRush. Make sure you guys use my link so you can get an hour of tutoring with me. Full details can be found at ftstutor.com. So I hope you guys enjoyed this video, and I will see you guys next time.